You have spent hours reviewing charts, days analyzing stocks, maybe months or even years learning stock analysis and investing. All of this to find out that you just wasted your time. And all you had to do from the very beginning was to buy a broad market index fund, dollar cost average on it, and in the long run, you would have outperformed most professional active managers by joining the market instead of trying to beat it. Now, is this actually true? Well, at least according to economist Eugene Fama, it is, through the theory he popularized back in the 1970s called efficient market hypothesis. This hypothesis assumes a market with rational investors, where the price of the assets are a reflection of all available information. Since the market rapidly and efficiently adjusts the price of securities to available facts, it considers that all prices are trading at their fair value or very close to their fair intrinsic value, since all the news that could have an impact on it are already priced in, because everyone has access to this information, and just like you saw it, so did everyone else, and they have already reacted to it. And these are things like law changes, company risks, negative or positive news, etc. If there are small inefficiencies, like a mispriced asset, the market quickly beats the price up or adjusts it downward to its fair value, making it extremely challenging to identify undervalued or overvalued assets and profit from them, especially constantly enough so that in the long run, when you look back, you have beaten the market. Now, this theory doesn't claim it is impossible to generate alpha, at least on its semi-strong and weak forms, which I'll explain shortly. Alpha, by the way, are any returns over the market benchmark. For example, if the market or a given asset is expected to return 10% and you generated 12%, you effectively beat the market and have a positive 2% alpha. But the theory claims that since all available information is already reflected on the price, inefficiencies are impossible on its strongest form and rare on its weakest forms. And if they exist, the market is fast to identify them and instantly correct them. In the practical real world, an oversold stock can be considered undervalued, and an overbought one can be considered overvalued as well. But under the EMH theory, investors simply react to all available news. So if the price increases significantly or decreases, it always shows the fair value, or something very close to it for that asset, considering the available facts, positive or negatives. For this reason, this theory supports passive investment rather than active portfolios. It claims that since alpha generation is difficult, especially in the long run, you'd be better off buying a broad market index fund or an ETF like BOO, which tracks the S&P 500, or BTI, which tracks the entire US stock market, instead of doing individual stock picking. Now, here's the important part considering some real-world factors. This theory divides itself in three different levels: the weak form, semi-strong form, and a strong form. The further you go into the levels, the more extremist, if you will, the theory becomes. Now, let's explore each one of them and see how they adjust to reality. The weak form. This form claims that technical analysis is pointless and hard to be used as predictor for future returns. It claims that previous patterns, trading volumes, bullish or bearish trends on a chart are not relevant for predicting the future, since all that is already baked in the current price. This happens because just like you can see all those facts and patterns, so can everyone else doing the same analysis, and they have already reacted to it. If Apple's stock has been increasing gradually for the past 5 days and shows a high trading volume, the trader might think that the trend will continue. But the asset is already trading at its fair value considering those facts, because all that information is already priced in. This form gives the benefit of the doubt, if you will, to fundamental investors, in the sense that analyzing the business financial statements, understanding the business overall and its risks, could be useful for earning higher returns, by spotting small inefficiencies that other people might have ignored, giving you the opportunity to generate positive alpha. However, these inefficiencies are not only hard to find, but it's very unlikely they are big enough to have gone unseen by the market and generate big returns. So while you might spot them, doing it constantly to beat the market in the long run is very unlikely. The semi-strong form. In this form, he challenges the idea he left the door open for in the weak form, claiming that not even fundamental investors can generate this alpha. This is because all the information you might find to support your analysis has already been priced in. The market, meaning everyone else, has already reacted to those financial statements, 10Qs, 10Ks, recent news, shareholder letters, etc. So if the stock crashed based on those factors or skyrocketed, under this theory, this is the closest valuation the market can give that asset to its true intrinsic value. So there is no over nor undervaluation. The market will react fast to new information that is released, adjusting the price accordingly and eliminating the room for that alpha. Since all public information is reflected on the price already, this form claims that the only people who can actually create higher returns and have more chances of beating the market are insiders, people who hold information that isn't public, so they have access to it before everyone else can react or even see it. So they can make the necessary adjustments to profit from it. If they hold good news, to which the market will react with optimism, they can buy more of those individual stocks. If the market will react with pessimism, they can short on it to make money on the downfall or sell to avoid losing money on the downfall. The strong form. This is the purest form of this theory. In this form, all information is already priced in. Therefore, the market is trading at fair values at all times. All public and private information has been accounted for, so neither insiders nor investors can beat the market. In this level, you can't hide anything from the market because it already knows everything. If you run a medical company and just discover a vaccine for a known disease, besides the CEO, there's also scientists, lawyers, other insiders that might have access to this information. So there can always be information leakage, which eventually reflects this insider information in the stock, adjusting it to its fair value considering those news. This hypothesis, of course, has its opponents, mainly behavioral finance advocates. Under behavioral finance, markets are not efficient, nor investors are rational nor interpret the information the same way. They don't invest using critical thinking, but they are influenced by several things that create small margins of errors in decision making, which, in aggregate, drives the price away from its true intrinsic value, with a gap big enough to challenge the EMH even on its weakest form. Among these things that create margins of error, we can include cognitive biases. And this is a variety of things, for example, attentional biases, which happens when you pay attention to certain things while ignoring others. For example, if you want to buy a phone, you might be focused on the brand and color while you ignore storage and RAM. Confirmational bias, which happens when you accept and welcome information that aligns with your own beliefs and reject or distance yourself from information that challenges those beliefs. And also optimism bias, which happens when you feel comfortable you have higher chances of succeeding or less chances of failure relative to your peers, among many other biases. Investors also develop herd mentality, which happens when you don't think independently, but you acquire the same beliefs and conclusions as the overall consensus. And most importantly, emotions, greed, and fear. Under behavioral finance, investors are not rational, and therefore the market, which consists of all investors together, cannot be rational or fairly priced either. Considering the main claim under EMH's strongest form, that all information is already priced in, the criticism against this theory is that in reality there is informational asymmetry. This means that not everybody has access to the same information. The one held by insiders has more leverage than public one. And even if all information is actually released, analytic capabilities vary from person to person. Also, delayed information dissemination plays an important role, as not all released data arrives to all ears at the same time, which is another EMH assumption. Investors like Warren Buffett, who have consistently beaten the market, also challenge this theory, under which his alpha generation is attributed to luck or skill to spot its small inefficiencies. To EMH, if a company decides to invest in an AI project, but this project's expected return falls below their cost of capital, the stock will collapse, as capital providers will not be getting the minimum return they expect. Now, let's say a small percentage of people think this is actually a good idea, and while in the short term the opportunity cost is negative, in the future it will generate higher returns. Let's say they were right. It starts paying off years later, and they profit from the price adjustment. EMH, in this case, would claim that when the stock collapsed, it was not undervalued. It was fairly valued or very close to it because based on the available facts or information at that particular moment in time, they were pursuing a project that generated less than the minimum return accepted, so the market reacted accordingly. These people who created positive alpha from this were simply lucky. They took a bet based on data that was not there yet, if we take the strong form, and simply turned out to be right. They could have held insider information if we assume the semi-strong form, or under the weak form, either held insider information or spotted those rare inefficiencies using fundamental analysis. But this doesn't break their model in the sense that when the stock plummeted based on the current facts at that moment, it was fairly valued. Definitely looking back at the different levels of these hypotheses, we can see an undeniable side that is mostly true, but also a side that it hardly ever is in reality. Past performance is not indicative of future results as the theory claims on its weak form, and this is a reality fact. On its semi-strong form, one could say that it's partially true. While the information you use to make fundamental analysis is public and just like you went through it, thousands of other investors did, and probably already reacted to it as well, several factors like the previous biases and different analytic capabilities can make a difference. But still, it's very difficult to generate alpha considering that you are competing with people from Wall Street, experienced analysts with connections, and insiders. The strong form, however, doesn't hold to reality. Insider information gives people a huge advantage, almost as strong as the power to see the future. This information can potentially help them make constant, easy, abnormal returns, which is the main reason why it's illegal in the first place. Popular metrics like the capital asset pricing model used to calculate the minimum return an investor should expect from an investment are highly influenced by the efficient market hypothesis. If you want to check my video about CAPM, I'll leave it to you in the description below. So what do you think? Do you believe markets are inefficient or do you support the efficient market hypothesis? I want to leave you with this analogy to think about. Say there are two investors. One represents the overall market and the other is an individual regular investor, and they both want to get to the same place. The market is given a long but straight path in an open field. So all it needs to do is slowly walk until it gets there. The regular investor is given a bicycle to go a bit faster, in a shorter way as well. But you need to cross a jungle to get to the final destination. This second path is filled with uncertainties. You might face wild animals, dead ends, steep hills, etc. So you're not necessarily moving any faster than the market. In the end, let's say 40 years later, four things can happen. The market arrived first. In this case, you'll feel like it was all worthless. You went through all that stress just for the market to get there before you did. Second scenario is you both arrive at the same time. This is no different than the first one. You could have just taken the easy route that took just as long to get there. But now, what if you get there first? This doesn't automatically mean you're happy. If the market gets there just minutes, hours, or even days after you, would you actually look back and say all those 40 years of trying to beat it were worth that gap? Finally, what if you get there way before? This is the true beating the market that we as investors want to get to, or at least the regular investor that is not well diversified but applies strategies like value or growth investing. This happens when the market gets there years after you, when you say that all those years back were actually worth the difference. Personally, I believe markets can be inefficient, and in the short term that becomes almost undeniable, so you can beat it from time to time. But in the long term, the real question is, are markets efficient enough that years from now, after spending hundreds of hours analyzing stocks, which compounded into months and then years of constant research, after paying transaction costs, bid-ask spreads, and taxes every time you traded, do you look back and say, I would have been better off simply investing in the broad market? Or are they so inefficient that you say, I did it, I beat the market? Let me know what you think in the comments. I thank you so much for watching, and please don't forget to subscribe to get more content like this. See ya.